It never starts with burning banks or people in the streets. Monetary collapse begins quietly, with numbers on a ledger that stop adding up, with promises that can no longer be kept. One day, the money in your hand buys food, shelter, safety. The next, it buys just a story, a memory of what it used to be worth. And the most unsettling truth is this: we've been here before, and we're walking the same path again. You're watching Hidden Finance, where we pull back the curtain on the forces shaping your money, your wealth, and your future. If you've ever felt that something about the financial system doesn't quite make sense, that the rules keep changing while you're not looking, you're exactly where you need to be. In this episode, we're going to travel through past monetary collapses, from gold-backed dollars to floating currencies and the age of printed money, and uncover the eerie patterns repeating right now. Stay with us, because understanding what happened last time may be the only way to prepare for what's coming next. To understand how a monetary system collapses, we first have to understand what a monetary system actually is. It's not just coins, notes, or numbers in a bank account. It's the entire set of rules, institutions, and expectations that tell us what money is, who creates it, and why anyone should trust it. Gold, paper, central banks, interest rates, exchange rates, all of it is part of a giant promise that tomorrow your money will still mean something. Throughout history, these promises have taken different forms. Sometimes money was literally metal, silver coins, gold bars, pieces of 8. Sometimes it was paper you could exchange for metal on demand. And sometimes, like now, it was just paper or pixels, backed only by confidence in governments and institutions. What almost nobody realizes is that global monetary systems are not permanent. They tend to last a few decades, then crack, then break, and then get replaced. In the late 19th century, the world ran on what looked like the most solid system imaginable, the classical gold standard. Major currencies were convertible into gold at fixed rates, and international trade boomed under this rigid framework. A British pound, a French franc, an American dollar, all were simply different claims on the same yellow metal. Merchants, bankers, and governments believed they had finally tamed money itself. But beneath the surface, the rigidity of gold meant that when shocks came, the system had almost no give, only break. World War I shattered that illusion of stability. Governments printed money massively to fund the war, suspending gold's convertibility as they went deeper into debt. Prices soared, currencies weakened, and the old pre-war parities no longer made sense. After the war, politicians tried to turn back the clock, to restore the gold standard as if nothing had changed. Britain, for example, returned to gold at an overvalued rate, locking in deflation and economic pain. The system limped forward, but trust was already bleeding out. By the late 1920s, the so-called gold exchange standard, a patched-together successor to the original gold system, was dangerously fragile. The United States and France hoarded gold, while other countries stretched themselves thin trying to maintain fixed exchange rates. Germany wrestled with reparations, Britain with stagnation, and many nations depended on short-term foreign lending to survive. When the U.S. stock market crashed in 1929, the pressure on this fragile monetary order became unbearable. Capital fled, banks failed, and each country began to choose national survival over global rules. In 1931, Britain stunned the world by abandoning the gold standard, letting the pound sink. It was a signal the old world monetary order had cracked. In 1933, the United States followed in its own way. President Franklin Roosevelt closed the banks, suspended gold convertibility at home, and banned Americans from owning gold bullion. The dollar was devalued. The link to gold weakened, then effectively severed for citizens. The message was clear: when defending the monetary system conflicts with social and political stability, the system itself is sacrificed. The first modern global monetary order fell not with a single announcement, but through a chain of desperate, irreversible decisions. Out of the devastation of depression and World War came a new idea. If uncontrolled markets and rigid gold rules had failed, Maybe nations could design a better system together. In 1944, as World War II was still raging, delegates from 44 countries met in Bretton Woods, New Hampshire. Their mission was ambitious: to build an international monetary system that would be stable, but flexible enough to avoid another 1930s-style collapse. Two visions competed: John Maynard Keynes's Grand Global Currency Plan and U.S. Treasury official Harry Dexter White's dollar-centered design. In the end, the world chose the dollar. Under the Bretton Woods system, the U.S. dollar was tied to gold at a fixed rate, $35 for 1 ounce. Other countries pegged their currencies to the dollar, which effectively made the dollar the backbone of global money. Only foreign central banks, not ordinary citizens, could convert dollars into gold. The International Monetary Fund was created to help countries defend their exchange rates during tough times, while the World Bank was set up to finance reconstruction and development. The United States, holding more than 2/3 of the world's gold reserves at the time, was the only country powerful enough to anchor this system. In the 1950s and early 1960s, Bretton Woods seemed like a triumph. War-torn Europe and Japan rebuilt quickly under the stability of fixed exchange rates. Trade flourished, growth surged, and for millions of people, living standards rose at a pace never seen before. But once again, the seeds of collapse were already quietly germinating inside the very structure that made the system work. The fundamental problem was identified by economist Robert Triffin, and it would later be called the Triffin Dilemma. For the rest of the world to have enough dollars to trade and hold as reserves, the United States had to supply them, which meant running trade and budget deficits. But the more dollars the US sent abroad, the more people began to question whether there was really enough gold at Fort Knox to back them. By the 1960s, the total number of dollars held overseas far exceeded the US gold stock valued at $35 an ounce. The math simply did not work anymore. At the same time, American politics made the dilemma worse. The United States was fighting an expensive war in Vietnam and launching expensive social programs at home. Instead of raising taxes or cutting spending, it increasingly relied on creating more dollars. Foreign central banks, especially in Europe, started to notice the growing gap between U.S. promises and U.S. gold. France's President Charles de Gaulle openly challenged the system, sending ships to New York to exchange dollars for gold and denouncing what he called the exorbitant privilege of the United States. In response, the United States and its allies formed the London Gold Pool in 1961, pooling their gold reserves to defend the $35 price. For a few years, they managed to hold the line, selling gold into the market whenever the price tried to rise. But as speculative pressure mounted and U.S. deficits grew, defending the peg became impossible. In 1968, the gold pool collapsed, and a two-tier system emerged: an official gold price for central banks, and a free market price for everyone else. Once again, the system was cracking in slow motion. By the early 1970s, the situation had become untenable. Foreign countries held mountains of dollars they could legally convert into U.S. gold, but there wasn't enough gold at the promised price to meet the demand. Inflation was picking up, confidence was eroding, and U.S. gold reserves were draining away. On August 15, 1971, President Richard Nixon went on television and announced that the United States would temporarily suspend the dollar's convertibility into gold. In one stroke, he broke the core promise of Bretton Woods. The dollar was no longer as good as gold, it was just the dollar. There was no panic in the streets that night. Banks did not close, people still used dollars the next morning, and life went on. But the global monetary order had changed irreversibly. Temporary measures became permanent. Attempts to patch things up with new fixed rates, like the Smithsonian Agreement, failed quickly. By 1973, the major currencies of the world were floating freely against one another for the first time in modern history. The consequences were swift and painful. Freed from the discipline of gold, governments leaned harder on the printing press. Inflation surged through the 1970s in country after country. eroding savings and rattling the middle class. Oil shocks amplified the problem, as OPEC raised prices and imported inflation spread like a virus. Ordinary workers watched their paychecks buy less every year, while Boreas found that inflation quietly ate away their debts. Once again, the system's reset had chosen winners and losers. In the United States, the breaking point came with double-digit inflation and a collapsing bond market. In 1979, Federal Reserve Chairman Paul Volcker made a brutally simple choice: save the dollar, even if it meant breaking the economy. He drove interest rates to nearly 20%, choking off credit and slamming the country into a deep recession. But inflation collapsed, and a new era began, an era where the dollar was no longer backed by gold, but by high interest rates, powerful institutions, and an unprecedented web of global finance. In parallel, deals with oil-producing nations ensured that crude oil would be priced in dollars, cementing the petrodollar system and locking in global demand for U.S. currency. So how do all these past collapses connect to the system we live in today? In each case, the interwar gold standard, Bretton Woods, the early fiat dollar order, the pattern repeats. Debt builds up, political promises outgrow economic reality, and the rules of the monetary game become incompatible with the needs of societies and governments. At first, leaders deny anything is wrong, then they stretch the rules. And finally, when the pressure is unbearable, they abandon the old system and write a new one, often overnight. The global monetary system that emerged after the 1980s is unlike any we've seen before. Money is no longer metal, nor even a claim on metal. It is credit, debt, created mostly by commercial banks with a few keystrokes, multiplied across a world of derivatives, shadow banks, and complex financial instruments. The dollar sits at the center, used for trade, reserves, and global borrowing. As long as trust holds, this web of credit behaves like money. But when trust breaks, it behaves like dry tinder. We saw a glimpse of this in 2008. The crisis that began in U.S. subprime mortgages metastasized into a near-fatal seizure of the global dollar system. Major banks were on the brink, money market funds wobbled, and international trade finance started to freeze. Behind closed doors, the world's central banks did something unprecedented. They created money on a massive scale and lent dollars to each other to keep the system from imploding. The patient survived, but only because it was put on life support in the form of near-zero interest rates and years of money creation known as quantitative easing. The 2010s were an era of deceptively calm waters floating on a deepening structural problem. Interest rates in many advanced economies sank to zero or even below zero, something almost no one had thought politically or economically possible. Governments, companies, and households piled on more debt because debt was cheap and often necessary just to keep growth alive. Asset prices, stocks, real estate, bonds, soared, enriching those who owned them and leaving others behind. Inequality widened. A system that once claimed to reward prudence and saving now openly favored borrowing and speculation. Then came 2020. In a matter of weeks, the global economy was deliberately shut down in response to a pandemic. Tax revenues collapsed, spending exploded, and central banks printed money at a speed and scale that made 2008 look modest. Stimulus checks went directly to households, markets were backstopped almost instantly, and once again, the system held, but only after another enormous dose of monetary morphine. By 2021 and 2022, the side effects arrived: inflation at levels not seen in 40 years. Central banks reacted with the fastest interest rate hikes in modern history. The cost of borrowing surged. Housing markets cooled, risky borrowers trembled, and governments suddenly faced much higher interest bills on their towering debts. Beneath the headlines, the question whispered through bond markets, trading floors, and ministries of finance was the same ancient question: can this system keep its promises? Can debts this large, at interest rates this high, really be repaid without either default or inflation? This is where the past and present collide. Every previous monetary collapse began when the burden of the old rules became politically unbearable. In the 1930s, countries refused to tolerate deep deflation just to stay on gold. In 1971, the United States refused to lose its gold reserves and its domestic prosperity to maintain Bretton Woods. Today, the world faces a different but related dilemma. Can democracies impose the spending cuts, tax hikes, and financial pain required to stabilize debt? Or will they once again choose the path of monetary escape? Meanwhile, the dollar's unquestioned dominance is being tested from outside as well as inside. When the United States and its allies froze Russia's foreign reserves in 2022 as part of sanctions, other nations noticed. If reserves can be frozen, they are not truly risk-free. Countries from China to the Middle East to Latin America have started to quietly diversify, buying gold, signing energy deals in other currencies, and talking openly about alternatives to the dollar system. At the same time, central banks are experimenting with digital currencies, while private actors build systems of stablecoins and cryptocurrencies that live outside traditional banking. The monetary map is fracturing. A future monetary collapse may not look like Weimar-style hyperinflation or a single dramatic announcement on television. It could be slower, stranger, and more technical. A series of crises that lead to capital controls, bank bail-ins, surprise taxes, or rapid inflation that silently shrinks debts. It could involve the phased introduction of new digital currencies under new sets of rules, justified as modernization or efficiency. It may even unfold unevenly, with one part of the world clinging to the old dollar order while another experiments with a rival system. But the essence would be familiar: old promises quietly broken, new promises quickly written. History does not repeat, but it rhymes in uncomfortable ways. When monetary systems collapse, it is ordinary people, savers, workers, retirees, who pay first and most. Their wages lag, their savings lose purchasing power. Their pensions are adjusted, and only in hindsight do they realize that what failed was not just a policy, but the very architecture of the money they relied on. Yet there is another side to these resets. Each collapse forced the world to rethink what money should be and who it should serve. The post-war system helped rebuild shattered economies. The move to floating rates enabled more flexibility and innovation. The question now is not whether this system will change. All past systems eventually have, but whether we will be ready when it does. In the end, every monetary system rests on a single, fragile foundation: the belief that tomorrow, the promises made today will still mean something. If you found this journey through hidden history illuminating, this is just the beginning. On Hidden Finance, we dig beneath the headlines to uncover the quiet shifts, the forgotten decisions, and the buried incentives that shape your financial reality. Subscribe, follow, and stay with us as we track the fault lines in today's monetary order, from digital currencies to debt crises and beyond. Because the next time the system changes, it won't send you an invitation. But you can see the signs if you know where to look. This is Hidden Finance, where the stories behind the money are finally brought into the light.